Justin. I work with State Employees Credit Union. I work here in Chapel Hill at the branch on Pittsburgh Street. That's really near campus, right across from the School of Social Work. I've been doing this for about 8 years now, and I've lived in Chapel Hill or Orange County almost my entire life. So I've got a good amount of familiarity with this area as well. First, buying a home for the first time can be a little overwhelming, and hopefully this will help to clarify a little bit of that process. We'll also have time after this presentation to ask some questions, and at that point in time, I can answer any sort of questions regarding home equities, refinances, purchases of second homes, or even vacation homes. Or investment homes. So all of those things are on the table with the question and answer portion of this presentation, but we will be specifically covering the first time home buyers process. So I'll get into that right away. All right. So the overwhelming part of the process is just knowing where to start sometimes. Generally, what we want to do is just help you be more prepared for, so when you go into a real estate agent's office, or when you come into a mortgage loan officer's office, you may know the right questions to ask or be more prepared, so that it's not so overwhelming when you get that process started. So understanding your credit is probably the first thing that most people should do at the process for looking at buying a home. As a consumer, you have the right to receive a free credit report from any of the three major credit bureaus. That is Experian, TransUnion, and Equifax. Those are the three credit bureaus. Most financial institutions will recommend annualcreditreport.com. The big reason they like that is because you don't have to enter any of your card information to get your credit report. So with annualcreditreport.com, you don't get your credit score, but you do get all of the information that you need to know what's going on with your credit. They also offer a bunch of other credit reporting information where you do pay and you do get your credit score as well. Anytime that you are applying for any type of loan, you're going to have this credit pull. So it's good just to know anyway where you stand with your credit. But the big things that you want to look for is if you have anything inaccurate or negative reporting on your credit. These would be things like late or default payments, collection accounts, charge-offs, slow pays, or medical collections. Sometimes these things may be reporting incorrectly, and so disputing those or resolving those with those lenders or the companies that are reporting those derogatory debts is something that you'll need to do before you start the process. Once you have gotten your credit in line, the next step is determining what you think that you can afford. We have a ratio that we use to determine what we can qualify you for, but that doesn't always fit everybody's box. So, some people like to travel a lot, go out to eat a lot, spend a lot of money. They may have less money in their budget to purchase a home than someone who lives a little bit more meagerly. So the best thing to determine what you can afford, and this is what I always tell people in my office, is to practice what you can save. What do you have? What can you afford monthly, and then also save on the side. The best way to determine what you can afford is really only known by you. And so we can tell you what we can qualify you for, but really that's more of a conversation that we'll have on what really is affordable for you, because we don't want to put you in a situation where it is unaffordable. If you plan on applying for a mortgage soon, understand also that any new debt can impact your approval. So if you've been pre-qualified already for a mortgage, if you're opening any new credit accounts, that can negatively impact your credit score. However, if your goal is for ownership is for long term, you don't have much credit, it might be good to build a little bit of credit as well before applying. So there's a conversation to be had about your credit too, maybe before you start looking at a home. So like I was talking before, when you're preparing for home ownership, it's important to create a budget that promotes savings. A big factor when you're purchasing a home is going to be what is affordable for your closing costs, and in some cases, what you need for a down payment. A down payment are funds that are paid up front by the buyer when purchasing real estate. And the amount typically is a percentage of the purchase price. So for instance, you get a interest rate break generally once you get to 5, 10%, or 20% down on a mortgage. So another expense in a mortgage is going to be private mortgage insurance, and some people call that PMI. That may be required on transactions of less than 20% down. PMI is a type of mortgage insurance and is a part of most payments when you're putting less than 20% down on a property. At the credit union, we don't charge that on any of our products, but that's something that you would find almost everywhere else as part of your payment. Closing costs are another expense that are separate from your down payment. These are fees that you use to finalize the real estate transaction. That's fees like attorneys, home inspectors, appraisers, origination fees for the mortgage, as well as escrow charges. And escrow charges are your homeowner's insurance and your annual property taxes. And those are part of your mortgage payment with a lot of lenders. With State Employees Credit Union, that's a part of your payment with all of our loans. So it's something you don't have to worry about paying yourself. We pay that for you annually when those things are due. And that's part of your normal payment that saves up and pays that later.
Yes, and what is the approximately cost of like closing costs? How should someone expect to pay for closing costs?
Oh, so closing costs can vary mostly depending on the price of the home, sometimes the location of the home. But if say you're buying in this area, you're probably looking in the price range of $400,000 or so or more. You're looking at probably $7,500, $8,000 of closing costs, but that can vary depending on a lot of things. If you're like in the city limits, you may have more property taxes, and so you may have more money going towards closing costs to pay because your property taxes are just going to be more if you're in the city limits, especially in Chapel Hill or Hillsborough, where the property taxes are higher than almost anywhere in the state. So if you're buying outside, the closing costs could be less. There's a lot of things that go into those costs. One of them is how much you're financing, but yeah, generally if you're buying a more expensive home, there's going to be a little bit more closing costs. But I would say probably average right now is probably like $7,500 closing costs for a home. And then, a lot of places will require that you put a down payment as well. Credit union, we will finance 100%. We'll talk about that a little bit more in a minute. One thing that's really important about purchasing a home is making sure that you have savings or the ability to save on the side after you've paid for your down payment or closing costs. Your solely responsible for the maintenance and upkeep of the home once you buy it. And there can be some fairly expensive things that go wrong with your house. So you want to make sure that you can pay for that and it doesn't put you in a really bad spot if it does happen. You have heating and air, your roof can go out, you need new siding, new paint, hot water heaters. There's lots of things that can go wrong when you buy a new home, and making sure that you have money for that type of thing is a big factor in determining if it's going to be affordable for you. When you're a renter, you have a landlord who's going to take care of a lot of that stuff for you, and you don't have to. But when you own the home, it's yours, and you have to keep it up. And letting things, you can't just let things go south on your house, because that creates a domino effect. So making sure that you have the savings required to meet any of those emergencies as those occur is really important when you're planning to purchase a home. Another thing is selecting a real estate agent to assist you with finding a home. That's something that I can't recommend highly enough. As a buyer, you don't pay for the real estate agent. That's paid by the seller. So when the seller sells the home, a portion of what the seller make goes towards those agents. So you don't pay them anything, but you get all of their expertise. They know about the local communities. They know, like, if the house has had other bids on them. They know a lot of stuff that just nobody else is going to know. They know what a good offer is going to be. They know if there's something like a red flag when you're touring the home to ask about. A real estate agent really is your guide to finding a home, and they have some really good insight. And so finding a good agent is something that's going to be really important for you as well. There's a couple of types of mortgages, and the main two types of mortgages are going to be adjustable and fixed rate mortgages. An adjustable rate mortgage is a loan that has interest that can periodically adjust over time, and that's based on a market index. Typically, the adjustable rate mortgages have a lower initial interest rate than a fixed rate mortgage. So there's a fixed period of time where the interest won't change, but then it can change. So some places have a adjustable rate that you buy your home and that rate stays the same for 5 years. After that 5 years, it may adjust every year, or it may adjust every 5 years after that. The credit union's adjustable rate mortgage is locked in for the first 60 months or 5 years. And then at that point in time, it can adjust as much as 2%, or for every 5 years, or 6% over the life of the loan, but it won't be but every 5 years that it adjusts. That can vary lender to lender how they offer their adjustable rate mortgages. But the credit unions is a 5 and 5 adjustable rate mortgage is what that means. So right now, when we're looking at adjustable rate mortgages, we're doing a whole lot more of those than the fixed rate mortgages, and I'll get into that in a moment. Fixed rate mortgages are different than adjustable rate mortgage in that the interest rate is the same for the life of the loan. So a lot of times people don't want to worry with the rate changing or potentially going higher than in the first 5 years. And sorry about the slide there. So typically with the fixed rate mortgage, that rate's going to stay the same over time, but that doesn't necessarily mean that your payment is going to stay the same. If your insurance goes up or your property taxes go up, your payment can go up annually too, because that's typically included in what your payment is. But for borrowers who want to know the exact amount of interest that will be paid over the life of the mortgage, it's great. The monthly payment with escrow can change, but that's with any mortgage. That's going to be the same thing for adjustable and for fixed rate mortgages. So even though that principal portion of your interest will remain the same on the loan, the monthly payment can adjust. Right now, ARM rates are much more popular because we're at 20-year high interest rates. And so people hear that and they think, oh, no, it's not a good time to buy because the rates are so high. But one of the good things about the adjustable rate is because we're at 20-year highs, locking it in an adjustable rate, it's highly likely that you're going to stay below that fixed rate potentially through the life of the loan. When you run the scenarios, even if you're going with an adjustable rate today, it could be 12, 15 years before you start saving any money on the fixed rate. And so there's a lot of factors that go into, is an adjustable better for you than a fixed rate? How long you're planning on living in the home is one thing. If you don't think they're going to be there more than 7 years, an adjustable rate's probably the best way to go. That's 7, not 70 years. But if you're planning to be there less than 7 years, adjustable rate's almost always the better way to go, because you're saving so much interest in that first 5 years. 2 years ago, when the rates were at all-time lows, the fixed rate was clearly the best way to go, because you have that locked in for 30 years. So depending on the time and what's going on with the housing market and what's going on with rates, can determine what the best option for you is. And right now, for almost everybody, it's an adjustable rate.
Justin, do you have any insight on how these rates might change over the next 12 months or so?
I wish. Right now the indication from the federal, well, 3 months ago, the indication was maybe one more increase this year, but then they just increased a couple of weeks ago, and there was an indication that there might be a smaller increase coming before the end of the year too. So it's expected probably that they're going to go up this year, but we've been hoping that they're going to plateau for a while. But if I could tell you what they're going to do, I'd be making more money doing something else.
I appreciate that.
But no, the big thing is right now the rates are pretty high. But houses are still a good investment anywhere here, really, from Winston-Salem all the way through Raleigh, that corridor. There's just not enough houses. And so homes are really holding their value. So even though you may not be getting that great rate that people were being offered 2 years ago, it's still a really good investment. And people can always refinance too if the rates come down. So if in 2 or 3 or 5 years rates start coming down, you can always have the conversation with your mortgage person about if it's a good idea to refinance and how that would save you money over time, and then you can discuss getting into one of those better rates that makes more sense. So it may be high rates now, and that may be deterring some people from thinking about buying a home, and that's okay. But buying a home is still a good investment here in this area of the state.
We do have a question in the chat, if you don't mind. This may make sense to you. Can you refinance out of an ARM? And I recall the banks were in trouble for the ARM loans back before the housing crisis in 2008.
Yeah, so you can always refinance out of an ARM to a fixed, and a lot of people were doing that 2 years ago. But in 2008, it wasn't necessarily adjustable rates that was the problem. It was the fact that they had these interest only options on the payments. So one of the big problems was that these mortgage lenders, they didn't have to look at really income. They didn't have to verify it. So they were giving people way more home than they could afford. And then they were giving them these interest only options. So they're not paying the principal down. So they were paying just the monthly interest. So every month that went by, they owe the exact same as they purchased the home for. So they're only paying interest on the loan. And the idea was, they thought that mortgages were not, or home values were not going to go down. There just wasn't a formula for home values going down. So they just didn't think this was risky to do, especially for people that were buying investment properties. They don't do that anymore. That's not offered anymore. When you're paying on your adjustable rate mortgage, you are paying down your loan, and you're paying it at a reasonable speed, so that you aren't just floating there, not paying down that mortgage at all. So now it's completely different than it used to be. And adjustable rate mortgages, and I can speak to the credit union right now, they are the better product. And it's hard, especially if you're a first-time home buyer and not putting down a down payment. It's really hard to find a better deal.
Thank you. Well, we're on that topic. Another question that just came in was, does refinancing cost money? Approximately how much would that be?
There are additional closing costs associated with refinancing, and what we do when we look at refinancing is how long is it going to take to recoup those costs, and do you plan to be on the home that long? So sometimes if you refinance and get a much better rate, you may, with the savings, within 3 years, have paid for all of those costs and you're back. You're now saving after that point in time. So if you think you're going to be in the home that long, we can kind of run scenarios to say, is this beneficial? How long before it's beneficial for you? And that's something that you don't have to know yourself. You can come in and we can have that conversation.
Thank you. That's it for now.
Okay. All right. There are some programs that are offered for first-time home buyers. And we can work with those at the credit union, and most financial institutions can as well. One of them is the Federal Home Loan Bank of Atlanta, and that's the FHLBA's First Time Home Buyers product. This one's a little wordy, so I kind of just run through it because there's certain people that qualify and don't. But it grants a forgivable second mortgage. And so a second mortgage is basically a second lien on your property. So you can't sell the home without paying them back. But generally what happens is they give you $7,500 in down payment and closing cost assistance for the purchase of a home by a first-time home buyer. For the borrowers eligible to receive those grant funds, they have to contribute a minimum of $1,000 of their own funds towards the down payment of closing costs. But that's far less than the average $7,500 that we talk about most people having to come up with for those closing costs. So it's still only $1,000 that you have to come up with to qualify for this. But these funds won't have to be repaid at all if you remain in the home at least 5 years. So there's a few calculations, and this is what we sit down in the office with you and figure out. But there are a few calculations that they'll go through, and they go through your total household income. It must be equal or less than 7 or 80% of the county area median or the state median family income. There's a whole other list of qualifying factors, but we go through that with you to determine if this is going to be a good option for you. This is for first-time home buyers, and this can be used in combination with the mortgage credit certificate. We'll go over that in a moment. But it does not, we can't use it in conjunctions with state employees credit union first-time home buyer. So it's either or, but this one may be a little bit more beneficial than what the credit union offers. The next product that you may be interested in, and you don't have to be a first-time home buyers for, is the Federal Home Loan Bank of Atlanta's Community Partners product. This is a consumer help for people purchasing a home of up to $10,000 in purchase assistance. And this is specifically for current or retired law enforcement officers, firefighters, first responders, educators, healthcare workers, veterans, active duty members of the U.S. military, and surviving spouses of deceased U.S. military members, as well as COVID-related essential workers. So funding is available for both first-time home buyers and non-first-time home buyers who meet the product eligibility requirements. To be eligible, you have to contribute, like the other one, a minimum of $1,000 of your own funds towards the down payment or closing costs. And you won't have to repay any of these funds if you remain in the home at least 5 years. Same thing as before, income must be less than or equal to 80% of the county area median income or the state median family income, whichever is greater. It can also be used in combination with the mortgage credit certificate program, and we'll talk about that next. This is probably the most popular one that we run into, and this is the mortgage credit certificate. And so the North Carolina Home Advantage Tax Credit enables first-time home buyers, military veterans, or members purchasing a home in a targeted census tract to save money on federal income taxes with the mortgage credit certificate. So this isn't money to close. This is a tax benefit after you purchase. The program is available subject to income and price limits, and the member qualifies for a federal tax credit of 30% of their mortgage interest paid each year. So that's up to $2,000 a year of a tax credit. And that just reduces your total tax liability for owning a home while you're under that mortgage credit certificate. So same thing, most financial institutions can help you apply for this. And we can use it with most of our mortgage products at the credit union as well. The credit union processes these requests at the time of the mortgage. The mortgage credit certificate does have a fee of $475, and so that goes to the NC Housing Financing Agency, not the financial institution where you're initiating that. One thing with any of these three programs, though, the mortgage credit certificate, the federal community partners product, and the first-time homebuyers product from FHLBA, all of these things kind of extend the time to close. So generally, we need about 30 days from the time you go under contract buying a home. These generally require you to close in 45 days. So sometimes people that may want to use these may not be able to purchase a home that they want because the seller may want to close in 30 days. So sometimes we see people sacrifice this in order to get the house that they want as well. So this isn't something that always works or should always be relied on when you're looking at a home, but they can be some really great tools to help you purchase your home for the first time, or even in the with the community partners product, anytime you're buying a product. So a lot of things that the credit union offers. Probably the most popular thing that we offer is our first-time home buyers product. We finance up to 100% financing. A lot of places aren't doing that anymore. We finance 100%, and we also don't charge PMI. That's going to be a portion of your payment with almost any other lender. So first-time home buyers that are wanting to finance 100%, it's really hard to find a better deal than what the credit union's offering. So credit union offers mortgages designed to assist members who wish to realize the dream of owning their first home, and members who have not owned a home in the last 3 years, new employees of North Carolina state agencies, employees of the North Carolina public school system, existing employees who are relocating to accept a new position within the state of North Carolina are all eligible for the first-time home buyers program. It's a 5-year adjustable rate mortgage for the first-time home buyers, financing up to 100%. We can go up to $500,000 with 100% financing, so that's a really good deal. In addition to 100% financing, we'll allow borrowers to finance an additional $2,000 to help pay for some of their closing costs. So if you're buying a home that's $300,000, we'll finance $302,000 and give you $2,000 to help with closing costs. There's a 1% origination fee, but that's for all of our mortgage products, and that aligns with the industry standard as well. And additional information about our ARM or fixed rate products is going to be available on our website. It really is important to take some of these steps when you're looking at buying your first home, and then determining what type of mortgage best fits your needs and your budget. The biggest thing to do is reach out to an expert to start your process. If you've looked at your credit, if you've looked at your budget, talk with a real estate agent or a mortgage lender about the next step of the process, and you're dealing with experts that can talk about you and your situation to determine what's best for you. Additional things that people may be interested in as well, and I'll be happy to talk about, are investment properties, home equity lines of credit, second homes, or refinances. Those things are all things I'll be happy to answer questions about as well here in the question and answer portion. But that's the end of the presentation that I have for you today.
Thank you so much, Justin. At this time, we'll take questions from participants. If you have a question, please enter it in the chat or the Q&A box to remain anonymous. While we wait for questions to come in, I want to let you know that the Financial Wellness Series will continue throughout September 12th. And next week's session is a discussion on estate planning. So you can check out all of our upcoming sessions on our Work, Life, and Wellness calendar at hr.unc.edu/events for more details. Are there any questions at this time? question that just came in is, do these cover new builds or new manufactured houses and the cost associated with purchasing the land?
So right now, we can do new construction purchases. So these are homes like in neighborhoods where you're buying from a contractor that's making a bunch of homes. But if you're interested in like a new build, like with land purchase, that's not something the credit union offers right now, that we used to offer. But with the changing of interest rates and the fluctuation of building supplies, it was just something the credit union discontinued until we could offer a better product. But there are still lenders that do all of that stuff for purchasing a new home. Like if you're building home on family land, or you're wanting to buy land to build a home on, those are things that you can finance as well. And there are specific products offered by other lenders for that.
All right, questions are coming in. Thank you so much. So why is there a time limit on an improved purchasing amount after getting your credit pulled?
On approved purchasing amount? Oh, yeah. That's because if you so when you have your credit pulled and you get a pre-qualification, you're at the credit union, you're pre-qualified for 2 months. That's because credit can change. One of the things that you'll be advised against doing in a lot of cases is applying for new loans. You could have purchased a car or have new credit cards with balances, and that would affect your affordability. And so one of the things that we talked about earlier with 2008, part of that financial collapse was driven by not verifying income and affordability for a lot of folks. And so this is kind of a fail safe to make sure that you didn't apply for a loan, then go buy a bunch of stuff, or that your credit hasn't gone down because you didn't pay a bunch of stuff. So basically it's just determining your credit worthiness, or you're determining if it's affordable still for you every 2 months. So you don't have to apply all over again. They just pull your credit and send you another approval letter.
Thank you. And is there a credit score that's recommended for first-time home buyers? And what kind of debt to credit ratio?
Sure. Yeah, and I'll talk about all of that. Credit score recommended. You want to have a good credit score. At the credit union, it's not as important to determine your rate as of right now. So we have the same rate that we offer for everyone that we can qualify. So if you're above 660, you're in the range where you are approvable for our best rate. So most places, though, if you're applying, you want to be above 750 to 780 for the best possible rate. Anybody that's over 800 is going to be getting the best rate anywhere that you apply. As far as looking at your affordability, we have a debt to income ratio, and that's typically 43% of your gross income your debt should be less than that 43%. So if you make $50,000 a year, your monthly gross income is about $4,166. So of that $4,166 that you bring home gross, 43% of that would be $1,791. So if you were looking at, that's the number that all of your debts would need to stay below before someone who makes $50,000 a year would qualify for a home. So you would want all of your debts, including the mortgage, to be about $1,790 or less. It's recommended that your housing payment not exceed 28% of your gross monthly income. But once again, that's just a general recommendation, and everybody budgets and spends money differently. So some people need to have more extra money, more disposable income for things, and some people just may not. But the industry standard is the 43% of your gross monthly income. All of your debt should fall within that range. That's part of the reason, too. It's a lot easier to qualify with a partner or spouse, is because you may have two incomes that can help you qualify for more, although that scenario can change with everybody's situation.
Absolutely. Thank you. And definitely that quote that you gave, that was pre-benefits. Monthly take-home income, I will say, is a little bit higher for someone who makes that salary. So that must have been before the benefits came out. But another question that came in is, this individual has a decent credit score in the 700s, but they recently are out of Chapter 13 bankruptcy. So what is the waiting period to buy a home, or are they even eligible?
Yeah, so some places there may be a waiting period. We probably want to see credit established again after bankruptcy has been discharged. If you have a decent credit score after bankruptcy, though, that's something that can be considered. And there's no specific amount of time that we can say that you have to establish credit again, although most people would like to see that established again for a year or so, just to see that all your debts are being paid, that whatever has caused that bankruptcy has been resolved. Although there are situational things that can allow us to consider that too. So if you're applying with a spouse that has good credit, or somebody else that has good credit that's not under bankruptcy or didn't have that bankruptcy on their credit report, that's something that we can consider a lot quicker than that. If there's something that makes sense for us, why that bankruptcy happens, it seems like a one-time occurrence, death in the family that caused you to lose your job or have to travel somebody somewhere else, but now you've established a good job again. There's lots of things we can consider. So there is no real time frame, and it is a case-by-case basis on who's going to qualify. But no, if you're discharged, or the bankruptcy has been dismissed and you're no longer under bankruptcy, we can consider any of those, and it's just on a case-by-case basis.
Thank you. And if you're looking to buy a home and you have a good credit, but the other person does not, is it better to still include them or try to go in and on your own?
Once again, this is a case-by-case basis, and it kind of depends. If the other person's credit is really bad, it may be better to not have them on the application. But if it's just a couple of little things, where it's like one bad thing that was 5 years ago that's holding the score down, it really depends the situation. If the person seems like a liability, it's better not to have them on the application a lot of times. But for affordability purposes, sometimes you have to have them on there, and we can consider and look at all those situations. And none of those are going to immediately discount you just because one person has bad credit, but the other one has good credit. Like I said, we look at the whole picture. So it's something to have a conversation about if you're interested.
Thank you. Next question, would paying off my student loans hurt my credit before applying for a mortgage at sometime within the next year? My student loans are the longest standing credit account.
No. If you have other credit accounts, a credit card, auto loan, anything else, go ahead and pay those student loans off if you can. One thing that becomes detrimental with student loans, especially with the way a lot of people have them now that are deferred, we have to calculate a student loan payment. And so when we're calculating a student loan payment, it's generally going to be higher than what your income-based payment plan or what you've worked out with your student loans to pay. So we generally have to hold more against you than you would actually be paying if they weren't deferred. But no, it's not a bad idea to pay off your student loans. And in fact, when you pay those off, you may see a credit boost because you're shedding a lot of potential debt. It's installment debt, so you kind of get rewarded when you pay it off. And a lot of people end up, increasing their credit cards or doing something else as a result of paying that off because you have more monthly income. So, in most cases, paying off your student loans is a good idea.
Thank you. And is there a percentage of the home value that you should save up for expected repairs and maintenance?
A percentage of the home value, maybe not, but that is house to house. Some houses are bigger than others. Some houses may be expensive but smaller. In Chapel Hill, you run into a lot of that. You have a lot of small homes that cost a lot more than the surrounding area. So while the home cost may be a lot more. You'll probably have a smaller HVAC because the square footage is smaller. You may have a smaller water heater. You may have less roofing or less siding that needs to be replaced periodically. So, it really is the size of the house and the materials that you have on the house that you'd want to kind of look at. You want to look at like the age of the roof, you look at the age of the HVAC, age of a lot of the things on the house to determine what may be problems that you run across in the next 10 years too, as well, to determine what you need. But that does vary between houses. But it's a good to have to save as much as you can in an emergency savings account, not just for home stuff, but just life emergencies. It's always good to have that as well. So, there's times when emergencies or unexpected expenses stack up, and there's always other options that you can look at. If you have equity in the home, you can look at having a home equity line of credit. Basically, what that is that you take the equity that you have in your home and you have this other line of credit that's like a credit card without a card. Where you can borrow from that at a much lower interest rate. So a lot of people who've had a home for a few years will go get a home equity. So if there is an expense that they can't pay for with their savings or don't want to pay for with their savings, you can borrow from your home equity line of credit at a much lower rate than a personal loan or a credit card. So you're taking advantage of the equity in your home to keep your home up in a lot of situations like that as well. So it's good to save, but there's a lot of fail safes that you can look at when you're looking at protecting your home without putting yourself in danger.
Thank you. And on one of the later slides, you talked about the first-time home buyers program through the State Employees Credit Union. One of the things it said was 5-year adjustable fixed rate. Does that mean the home needs to be, you only qualify for that program if you can pay off the home in 5 years, or what does that mean?
No, that's before the interest rate could adjust. It would be a 30-year loan that can adjust every 5 years. I may not have been very articulate when I went over that product. So it's 30-year loan. It adjusts every 5 years. You can pick less than 30 years if you would like, but they're typically 30 years. They can adjust every 5 years. They can adjust as much as 2% every 5 years, but 6% is the maximum adjustment over the life of the loan. If it went up 5 years from now, and then 5 years later, it could go back down to the floor rate too if rates have gone back down too. So that's something that we've seen happen as well. Looking at the options between the adjustable and the fixed right now, we're at the 20-year high interest rates. A lot of people are looking at that and saying, in 5 years of the adjustment period, it's much more likely that the rate's going to be lower. I now have no adjustment, or that sometime in the next 5 years, the rate will be low enough that it'll justify refinancing. So that's why most people are looking at the adjustable rates right now, is because we are at 23-year highs, I believe is what it is this month. So we're at 23-year high interest rate. So in 5 years, there's a real chance that it's less than it is now. So a lot of people are taking that gamble with the adjustable rate mortgage, just looking at the trend.
Thank you. And will a mortgage cover expenses other than the new home? For example, renovations, kitchen appliances, bedroom furniture, etc.
No, not with a purchase. That's something that if you wanted to save up for, you can definitely do that. You can if you wanted to take a loan out after the fact, you could do a personal loan. After a year has gone by, if your home's gone up in value, we can always look at a home equity line of credit. But no, the financing of the mortgage only includes the home, and that's going to be for the appraised value or the purchase price, whichever is less. So if the home doesn't appraise for what you purchase it for, you have to bring more money out of your pocket to closing if you want to continue. So, of course, that's something too that you can negotiate with your real estate agent and with the buyer's agent on maybe a reduction in price because the home didn't appraise for the agreed upon price. So there's a lot of things that can go into that. But no, the purchase of the home is just for the purchase of the home. Even if the home appraises for more, we can only finance that purchase price.
Thank you very much. Are there any other questions at this time? Again, I encourage you to check out our work, life, and wellness calendar. I dropped the link in the chat box. It is hr.unc.edu/events to look at our weekly and monthly events. We have most of our topics up there through the end of the calendar year as we approach the start of our fall semester. If there are not any questions at this time, I just want to thank you again for sharing your afternoon with us and joining us today. Until we meet again, folks, have a wonderful week and be well.